In this video, I'm going to cover the next section of the cash flow statement. That is the cash outflow section. So that's just money that is flowing out of the business, whether that's, for expenses or rent deposits or salaries or anything like that where money is flowing out of the business. And for the first year of business or for the project, it's really important that all of the project or business startup costs from the first spreadsheet or the first tab are included on here, because you want to show when that money is actually flowing out of the business. So let's say, for example, I am using that counseling business here that I have on the first tab. I can make some adjustments here. Let's say with counseling, they only have services. So I can delete these two rows and maybe everything else is the same. This counselor is expecting, $1,000 the first month in June, and it's going to build up a little bit each month. And then they have the same amount of owner equity, and maybe they have the same business loan coming in. And then because the startup costs here were $25,000, let's say they are getting a loan for $20,000 and they're contributing $5,000 of their own money. So the first thing there on that top section is that the money coming in has to be enough to cover the money that's going to be going out, at least starting out. So now that we have that for that example, the next thing is just focusing on this cash outflow section. So what we can do is go back to our startup cost schedule, and we can just copy all of these items here. And then we can go back to the cash flow statement and we can just paste them just to make it more relevant to this specific business, because again, every business is going to be different. So we can look back to the first sheet here and just look at what our expenses are going to be. And we basically want to report those on the cash flow statement as they're moving out. So for example, rent deposit, if we go back, rent deposit is $2,350. So let's say maybe that, they are going to start paying rent on June 1st. And so they have to pay the deposit here in May. So we would report that there. And then going back, we have renovations for an expected $5,500. So maybe they're doing those renovations in May as well. $5,500 there. Property and business insurance, that is estimated to be $1,000. And same thing with legal expenses. So maybe they're getting that, both of those being paid for in May. And then maybe they're buying their, maybe they're doing their website a little bit earlier. So we'll skip to that one and we'll say we did it in April. And what was the website cost here? $3,000. So we want to fill this out with all those expenses, all those expenditures in the month in which they're being paid. And all $25,000 in this case should show up in, the first months of business, because those are startup costs. Now, on top of that, once the business is actually up and running, you're going to have some other ongoing expenses. So maybe you have things like utilities, and then maybe you have like monthly rent. Add that here. And then if you want, you could add another line. So we could do add a line, insert a row above. And then maybe we have our loan repayment each month. So first thing we want to do, as I mentioned, is just make sure we put all our startup costs here in the months in which they're coming out. And then we can start to add our ongoing costs as well. So maybe if that loan is being paid out in April, maybe this individual has to start paying the loan back in May. And so maybe their loan repayment each month is $600 or something like that. So we can put $600 in each month and just go from there. And you can see how this is going to be adding up on the right side here. For this one, because we added a new row, we can just click equals and then put sum and just have the whole row there, so that adds up for us. And then the next thing there, in this case, monthly rent. So maybe if the deposit was paid in May, maybe they get possession in June. And so we'll say rent is $1,175. Maybe they had to pay 2 months worth of rent as a deposit. So each month moving forward, we can add $1,175 as the regular monthly rent. And so that's adding up there. So you can see here, really just what we're doing again is, rather than reporting the cash inflows like we did in the top section, we're just reporting or projecting the cash outflows based on category, based on the month, both for the startup costs, like I covered initially, and then some of the ongoing operating costs that will be incurred as the business starts operating. And so you can scroll down here and see below that there's going to be total cash flow added up here. You can just double check just to make sure the calculations get every row in each section. So for that month, it was $3,000. And then you can see here that, this total cash outflow for the month of July is capturing both the rent and the loan payment. So that's just a quick summary as to how to add your cash outflows. And, this was just year 1 that I covered. You want to fill this out for year 2 and year 3. And so for year 2, again, you can change the dates if you're not starting until later on. I'm recording this in early 2026. But now in year 2, you're probably not going to be having more loans coming in. You might have some more owner contributions coming in. If so, you can add that. But by year 2, typically you're mostly focusing on money coming in through revenue by providing services or by selling products, or for both. So you can just report your monthly projected revenue by each source, and again, just adjust to add a name for those actual sources. And so now the same thing for cash outflows. You'll want to just adjust these to your business. So you could copy maybe from your first sheet here if you wanted to, and just paste it in year 2 if that fits. And then just adjust as necessary, because you might not have a rent deposit coming out, each year. It's just going to be a one-time thing. Maybe the same thing with renovations. So maybe you want to change these a little bit just to better reflect what's actually going to be happening in your business in year 2. And the same thing with year 3. So just measure, track, project your cash inflow by month per category for money coming in, and then down here for money going out.